Good afternoon, everybody. Nice smooth entrance there by the President. Everybody's very welcome to the AGM of the Statistical and Social Inquiry Society of Ireland. My name is Danny McCoy, and I have the great pleasure to be the President of SISI for this term. We've got a paper tonight which Donough Lawlor and Jean Acheson is going to be presenting, but we also have our AGM. So I'm going to hand over to our Honorary Secretary, Ronan Lyons, to talk us through the structure of that part of the meeting.
Thanks very much, Danny. And Maeve, would it be possible to put up the slide for the AGM? It's the second of the slides. So the only thing just to say, obviously everyone is welcome to attend today, but for voting, which we'll be doing, I suppose, orally or raising hands, if only those who are paying members can interact for that part. This whole part should only take a few minutes. Maeve, would you move to the next slide, if possible? Thanks very much. That's the agenda for our annual general meeting. The first are the minutes of the last AGM. So if anyone has any comments on the minutes for last year's AGM, you might make them known now or make them known by email after this meeting, and we can adjust accordingly. Otherwise, we'll take them as read and assume that they're approved. Oh, actually, sorry, we should technically get someone. Maybe someone would raise their hand to propose that they're adopted, and someone would second. Let's have a look at my participants. Oh yes, we've Barra and Barra Rowntree proposing, and John Fitzgerald seconding the minutes. I'll hand back to Danny for a couple of minutes. If Danny, if you want to give a quick President's overview.
Yes, thank you, Ronan. And really, it's been like in so much things in our society over the last year. It's been a dramatic year for the society as well. But I'd like to report that when we look across the year, I think it's been a great success in our move to remote. And the use of Zoom. We're reaching much greater penetration in terms of audience and participants, but also we've been able to, I think, deal with symposia that have been very relevant to the topics of the day. And I think that flexibility shows the strength and vibrancy of our society in its long history, that, you know, regardless of what phase we're going through economically or socially, that SISI manages to adapt well. I think the last year has been particular evidence of that. Next year, we will be 175 years old or young, as the case may be, and it is hoped that we'll bring forward some suggestions to mark that occasion. It's particularly relevant, I suppose, as well with the Queen's Colleges that were celebrating their 175th anniversary as well, that academic collaboration between the Society and the National University Colleges, and Queen's University in Belfast as well, in Galway and Cork, and the kind of regional spread. I think that reflection, the 175th, is something we can do a lot more interesting given this virtual world that we're now living in. We obviously hope as well that with the restrictions being lifted, we will go back to having that interaction of some physical meetings. But I think we actually have an opportunity now as a society and as a generation to get the best of both worlds here in these kind of hybrid models that we've been talking about. So more about the 175th anniversary next year. And always that great tradition that we have is the Barrington. The Barrington series continues to thrive and brings forward new and young researchers into the society, and I think that that's also been evident. I think when we look across at the participation and contributors to the society over the last year, I think that's a very positive platform. For different purposes, I read the proceedings of, I think it was 1851, and Sir Robert Kane, the very famous chemist, as vice president of the society, gave an update. The Barrington tradition is even older than the society itself, but I think that building on that idea of something of a legacy for future generations, that perhaps this particular generation of participants in the society might put in place something that may be more lasting as well. as our contribution, and we will put our collective heads together on ideas around that. And the final thing, Ronan, before I hand back to you, is to say that as part of the modernization of the society, we will be revamping our website for the next session. And I think there again, more interactive content in terms of the videos that we're now taking with Zoom as well could be a record, not just of the journal in print form and the recordings we have in verbal form, but also the visuals. And so that's why I've gone all galactical today. The future looks bright for the Flat Earth Society. You can see it's no longer flat. We can see the curve there. So with that, I'll hand over to you, Ronan.
Thanks very much, Danny. And I'll invite the Honorary Treasurer, Giselle Gavorskis, and with special commendation, given she's coming to us from maternity leave. Giselle, do you want to give a quick update on the Society's finances?
Yeah, let me share my screen. Oh, if it's possible. I think I can. Well, we have the account balance for 2020, and the expenses were increased in 2020 with respect to 2019, and the majority of that was due to rental. I suppose this next year, 2020 to 2021, is not going to be the case. And for the end of 30th September 2020, the account had 14,478, which was less than 2019, that it was 1,593. But as I said, it was because of the rental services.
Thanks very much, Giselle. And yeah, just by way of context for the members, the financial year of the Society runs to the end of September. So the accounts are sort of retrospective in that it would be the session ending September 2020, which would have included a lot of pre-COVID activities, which were face-to-face, for which we faced a rental bill, whereas that wouldn't have been the case once we're on Zoom, with thanks to Trinity Research and Social Sciences for hosting. So Giselle, thank you very much for that. I forgot, we'll need a proposer and a seconder for the President's remarks, and a proposer and seconder for the Honorary Treasurer's report. So again, if any of the members would like to raise their hands, Alan de Bromhead and Thomas Conifrey for the President's report, and Aideen Doris for the Treasurer's report. We might have one more member, or else I'll second, Owen Flaherty, to second the Honorary Treasurer's report, which brings me on to the Honorary Secretary's report. Normally, when we were face-to-face, I would read through the proceedings of all the meetings. With Zoom, what I think I'll do is just summarize the meetings of this session and read out, as I would normally in full, the record of the last ordinary meeting. So we've had, this is our 7th meeting of this session. The first ordinary meeting was a paper by Tim Callan and Karina Durley called Top Incomes in Ireland, Reconciling Evidence from Tax Records and Household Survey Data, with the discussion led by Aideen Doris and Robert Sweeney. That was in October. In November, the second ordinary meeting was a symposium with the theme Jurisprudence and its Impact upon Public Policy. And we had papers from Paul Gallagher, SC, Margaret Gray, SC and QC, and Michael McDougall, SC. The third meeting took place in January 2021, and that was the Barrington Lecture, which was given by Niall Farrell of Queen's University Belfast, and his lecture was called Has Fuel Poverty Changed and How Should Policy Respond? Charting Fuel Poverty in Ireland from 1987 to 2015. The fourth ordinary meeting was in March 2021, and the paper entitled Income Volatility on Dairy Farms in Ireland was presented by Jason Lockery, Declan O'Connor, Trevor Donlan, Tia Hennessy and Fiona Thorne, with the vote of thanks led by Tig Buckley and Paul Caskey. The 5th meeting of the Society was in April, and it was our 2nd symposium with the theme International Trade and Investment Agreements Fit for Future Purpose. The papers were delivered by Chris Barton of the UK Department for International Trade, Eilish Campbell, Canada's ambassador to the EU, and Martina Lawless from the SRI. The 6th meeting, and the one for which I'll read the full record, as I would normally do. The 6th ordinary meeting of the 174th session of the Society was held on Thursday, 27th of May, online, due to the pandemic and associated restrictions, with assistance from Trinity Research in Social Sciences. The President, Danny McCoy, was in the chair for a paper entitled A High-Frequency Model of the COVID-19 Pandemic in Ireland and its Trading Partners During 2020, and that was by Donald Smith and Luke Rahel of the Department of Finance and Haicheng Xu of the Southwestern University of Finance and Economics in China. The proposal of the vote of thanks was made by David Higgins of Carrickhill, while there were contributions from the floor by Danny McCoy, Ronan Lyons, Michael Darcy and Alan de Bromhead. Following the discussion and response from the authors, the President thanked those who had contributed and brought the meeting to a close. And that brings us to the last meeting of the session, which is today, where we'll have a presentation entitled A Review of 15 Years of Ireland's Corporation Tax Returns, to be given by Donough Lawlor and Jean Acheson of the Revenue Commissioners, with a vote of thanks led by Aisling Donoghue of Anderson, Ireland. That concludes the Honorary Secretary's formal report. The one thing I think it's probably appropriate for me to say is that for members who have a membership which entitles them to a hard copy of our journal, you may be wondering where the hard copy of the last session is. Long story short, delays related to the COVID-19 pandemic, and we're waiting for one final paper to be typeset, and then the distribution of the hard copies of the journals will take place. So apologies from all the officers of the Society for the delay, and we may hopefully have the situation where we'll have 2 different issues of the journal going out in relatively quick succession, if we can stay on top of the papers for the session just gone. So I'll finish my report there and beseech the membership to propose and second the adoption of my report, if we have any takers for that. Thank you, Paul, Paul Sweeney and Owen Flaherty. And I will hand back to the President for the election of council members and officers of the Society. Maeve, would you be able to put up the second slide, which has the members, council members that are retiring and up for re-election on it, if possible? If not, I can find it. Oh, yeah, perfect.
Yes, so as the Secretary said, the election of council members and officers of the societies, that members who are retiring and up for re-election are Donald de Butler, Robert Watt, Francis Ruan, Sean Lyons, Martin O'Brien, Alan de Bromhead, Alan Barrett and Aideen Doris. And a new member proposed by council is Jenny Connors. And Honorary Secretary, do we take a vote at this point in our?
So traditionally we would, for the members that are retiring, all of whom have opted to be re-elected, we would typically take them as a group and ask for someone to propose and someone to second. And if anyone, I think the best way to do this is if anyone disagrees with their election, just to unmute. So John is proposing, John Fitzgerald. And if we have a seconder for the returning members, and we do the same for Jenny as a new member proposed by council. I will happily second the returning members.
I'll propose Jenny as a new member.
Great, and I think I saw Jennifer Banham as well for Jenny. So if anyone, it's obviously difficult, I think, when it's not face to face. But if anyone disagrees, we would take silence as members voting in favour. But if there are members who would like to vote against, you might raise your hand. So I'll ask. I think. Paul, I know. Did you want to come in at this point? Not on the objecting, but did you want to come in at any stage in terms of an officer report?
No, I think the way you've described the journal is perfect. So people will see that we have it up in the archive, everything that we've ready, but we will put them together, get the page number right and the final paper in, and we'll be sending it out very soon, as possible. That's all I have to report on the journal.
Thanks, Paul. I think, President, that's the we've successfully seen the re-election of the members due to retire and the election of Jenny.
Excellent.
I'm not
Well
sure
done.
if that might be a slightly North Korean way of
Politburos come and go, but Sissy Council continues. That's refreshing on tradition. So Donough, I think at this point we're going to hand over to you. Donough Lawlor is Donough's of the Revenue Commissioners in the Irish Government Economic and Evaluation Service. I'm not sure if Jean is joining us, but it's a joint paper with Jean Acheson of the same house. So Donough, over to you on the title of the 15 years, a review of 15 years of corporate tax returns, 04 to 18, in a fairly spectacular time frame for historical purposes, but also for contemporary platform. Donough, can you unmute there?
Participant screen sharing. So,
okay.
I'm unmuted, am I?
You're unmuted. Can hear you now.
Sorry, it's saying it's saying the screen sharing is host link. Apologies about that.
It seems like your bandwidth is low, so you might turn off your camera just for the moment, and just try sharing the slides. I don't know, Maeve, if you have a copy of the slides, or if not, we can get them across and then put them.
Yeah, I don't have a copy, so if someone wants to send them on to me, then.
Yeah, I'll send them on there now. Sorry about that.
Thanks, Donough. And apologies to everyone attending for the delay. Given the topic, it'll be worth the wait.
Okay, Donough, we can see the first slide now.
Yeah, apologies about that.
No problem.
So, but before I start, I would I'd just like to say thanks very much to the Society for accepting the paper, and to Aidan Doris and the two anonymous referees for their feedback. It was very much appreciated and always very helpful. I'd also just like to say thanks to revenue colleagues Keith Walsh, the head of our division, and Larry McCarthy and Fionnuala Ryan. They're always very quick and helpful to provide information on all matters CT related. And lastly, I'd like to say, obviously, thanks to Jean Acheson. She's a co-author. She's not here in a professional capacity as she's out on maternity leave, but you could say she's in the crowd watching. So she obviously did a huge amount of work on that as well. So if we can move on to the next slide, please. So yeah, the outline for today is I'll give a bit of a brief introduction, a bit of talk on the panel creation, an overview of the panel, and then I thought the best way to go about this would be to pick some of the more interesting trends that have come from this paper, and probably some of the ones that are less well known. And then lastly, we'll try and draw some tentative conclusions from a recession analysis that kind of predominantly look at the employment figures. So if you go to the next slide, please. So Revenue regularly publishes information on corporation tax returns, and we can all kind of see this through their annual returns and receipts papers, as well as regularly updated statistics data sets. But these papers, they typically provide data on a single year in question, and there are references to previous years. What we tried to do in the economic research unit is to create a new panel data set of tax returns that captures the full population of companies filing CT returns from 2004, the oldest year available to date. The most recent one being 2019, which is just recently added. Like a panel data set, as I'm sure you all know, it allows for like deeper understanding than previously available. So for example, this could be like tracking key cohorts, such as over time, maybe looking at detailed sectoral decompositions over time, and to conduct further like economic analysis on the effects of macroeconomic and tax policy analysis, such as maybe examining a corporate tax elasticity with the micro data set. In this paper, we use the novel panel data set to examine trends in detail over time. And how I've grouped it is, we'll look at certain trends are confirmed, new trends, and we kind of broadly examine the recession years to provide insights into the crisis. So next slide, please. So quickly, like how we kind of create the panel is, typically the data is the actual CT1 return itself, and that's kind of scanned online to revenue systems, and there's a bit of cleaning there. And the CT team will clean that further, and it'll exist in a yearly data set, and that's the basis for all of the kind of analysis that revenue produces on CT. So what we do is we amalgamate those years over time by matching their internal identifier number, and then we can match them over time. We also do like further cleaning. It's never just as easy as like stacking 1 year of data on the next. So we do further cleaning to ensure the variables are consistent over time. And then some further cleaning is taking care of like multiple accounting periods to ensure that we only have one observation per year per company. So a company is only on the panel, they don't exist once per year. There wouldn't be multiple observations per year. Then we see like the company sector and group information they're obtained from other areas like revenue registration system and their large cases division, respectively. Other internal data that are used on the panel data set, which is not available, are stuff like the levels of are available but not used in this paper, are stuff like the level of PAYE, PRSI, universal social charge, and VAT liabilities. And then we do try and improve and expand the coverage of the data set, so other external sources will be utilized as well. And most namely, this is from the Bureau van Dijk FAME dataset and the Company Registration Office. And from those two sources, we can take information on like the multinational status and the age of companies based on their date of incorporation. And this kind of allows us to try and improve and expand the coverage of the data set. So if we can go on to the next slide, please. So this is just a high-level overview of the panel to give you kind of an understanding and a bit of a flavor of what's to come. And it's like some of the variables here, we have like the live number of CT registrations at the first row. And like these are kind of firms that get on to revenue to register for CT, and then the actual companies who fill out the corporation tax return and give it to revenue in any 1 year. And below you'll see a few more variables, which we'll talk about a little bit. But over the full period, we have like 297,000 distinct companies that we can analyze. And across the full period, we have, on average, there are about 129,800 filers. And a firm or a company can be in the panel on 1 year, it can be there for all the years, or it can drop in and out of the panel. We can also see then, if you look at the first red kind of rectangle, we can see that the average number of filers in the last 5 years, so it's increased from about 130 to about 153,000. That kind of reflects the expansion in the Irish economy the last couple of years, where the average has increased substantially. Another thing we do is we track a cohort of 2004 filers and see how many are remaining in future years. So if you look at the third column, you'll see the share of 2004 filers remaining. And then if you look in 2018, we can see that 45% of companies who filed a return in 2004 remain in 2008. Another interesting kind of insight from this overview is if we look at the numbers with positive gross trading profits on the fourth row, and we look at the the numbers with positive corporation tax liability, just like third from the bottom row, those two rows, you'll see that for the vast majority of years, the numbers with either no profits or no corporation tax liability, it's more than half for most years. So we'll move on to the next slide, please. So this slide here, this figure here looks at the corporation tax annual levels, and it also tracks corporation tax concentration over time. So we can see top 1% has increased steadily until about 2015, and where we can see it kind of dips a little bit and begins to moderate. But throughout the whole period, the top 1% has never been below, has never accumulated for less than 70% of all corporation tax liabilities. A similar trend is observed with the top 10 firms in terms of their liabilities. So we can see since 2012, the top 10 firms have on average contributed 35% of all corporation tax liability. And this peaked at 44% in 2018. You'll notice in the most recent corporation tax returns and receipts papers that for the first time, the top 10 peaked at 51%, and that's for corporation tax payments, so a payment actually made in the year. Whereas here we're looking at liability, so how much a company is liable to pay based on their return that year. But for a variety of reasons that they don't have to pay that liability specifically in that year, it can be kind of brought forward and whatnot. The main drivers of this of corporation tax growth since 2007, they've predominantly been information and communication and the manufacturing sectors. Another interesting piece of research we found was that Ireland is not uncommon with its degree of concentration. So like Singapore, UK, and Australia also have similar levels of concentration in terms of like a top 1% occupying such a large share of liabilities, while the US is even more constant again. Move on to the next slide, please. Thank you. So in slide here, we're looking at a cohort of companies in 2004 who have no corporation tax liability, and we track them in subsequent years. So if you look at the first column, excluding year, you'll see numbers of 2004 non-liable firms remaining. So in 2005, there were 39,646 firms who had no liability in 2004 that also were still in the panel in 2005. And if we go across to the second column, we'll see that all those 39,600 firms, 32,000 of them approximately still had no corporation tax liability. In other words, we can say that 81% of firms who had no corporation tax liability in 2004 also had no corporation tax liability in 2005. And if we go down to 2018, you can't actually see it here. I think it's a little bit hidden by the screen. But if you go down to 2018, you can see that 72% of companies with no corporation tax liability in 2004 also had none in 2018. So that's kind of quite a large amount, and it's quite a long period of time for this pattern to hold. And the pattern here is that once a company has no corporation tax liability, there is a very large probability it will continue in this category for an extended period of time. Now, this largely relates to the absence of profit for many companies. And if you repeat this analysis and take any year, so not 2004, but if we take any year in the panel, like maybe 2009, 2015, or 2016, this pattern largely holds, whereby if you have no corporation tax in 1 year, you continue in this category for an extended time. So next slide, please. Here again, we're going to look at kind of growth, this time across the corporation tax distribution, so across the percentiles. There's a lot going on here. So first, I'll probably direct you to the number 1, which is the first kind of oval. And we can see here that a downward sloping curve from left to right, it indicates liability growth is larger for the lower paying companies. So companies that are on the lower percentiles. And if you look at number 2, you can see that an upward sloping curve indicates the largest taxpayers experience higher liability growth. And what we do is we get the average growth rates across the percentile, and we take the average over the number of years stipulated in each period, and we plot them. And so if we categorize the recession period as from like 2007 to 2009, because we're looking at growth rates as well, we can see that all taxpayers experienced falls in their liability, irrespective of whether they were large or small taxpayers. And if we look at a period from 2009 to 2012, that the dark navy line, we can see that like small taxpayers experienced a much higher growth in liabilities. But this is probably caused by starting off from a low base to begin with. And then from 2012 to 2015, that light blue line, we can see a further contraction in the extreme growth rates experienced in the initial recovery phase. And then finally, for the last couple of years, it shows a further slowdown in liability growth across the distribution. And if we're to try and extrapolate this towards insights from coming out of the COVID recession, I think a pattern like this would suggest that while all companies will experience a reduction in their liabilities, the rebound will be uneven, where the tails of the distribution experience the quickest growth and kind of recover more quickly. So if we look at the next slide, please. In this figure here, we look at the probability of remaining a top taxpayer in each year if you were one in 2007. So you can see that the 100% there is in 2007. So that's the cohort of firms we're tracking. And a top taxpayer here is either in the top 10% or the top 1% or the top 10 firms. And if you look at the years from like 2007 to around 2000 up until about 2011, you can see that it's quite steep, suggesting that like most companies lost their place as a top taxpayer during the initial phase of the financial crisis. But from 2011 onwards, it starts to kind of flatten and moderate, probably as companies begin to recover and things begin to settle down. On average, if we look at 2018 and we take the positions of the final positions of those 3 cohorts, we can see that on average, just under 30% of companies remained in their cohorts by 2018. So remained in their top taxpayer cohorts. And then also, interestingly, we can see an upward kind of kink in some of the lines, and that kind of indicates that a company who was a top taxpayer in 2007 reclaimed their place as a top taxpayer in subsequent years. And this happened in like 2009, and it also actually happened in 2018, whereby a firm was a top taxpayer in 2007, like reclaimed its place as a top taxpayer in the most recent year. So next slide, please. So in this slide, again, we're looking at mobility for like in terms of corporation tax liability for selected deciles over 3-year periods. And again, there's a lot going on here. So maybe if I could direct your attention to the furthest left three columns, and we can see that if you look at the bottom rectangle at the bottom, you'll see that indicating where the company began. So we can see that, and if we look at the very furthest left column, we'll see that 40% of companies who were in the bottom decile in 2007 remained there in 2009, and 60% of companies moved up and out of it. If we look at the middle 3 columns, it all deals with companies who began in the middle decile. And maybe if we look at the very middle one, we can see that 53% of companies who began dropped down to a lower decile in 2011. And the pattern here from the middle deciles for all the years examined is suggesting that a larger proportion of companies who began in middle decile moved down to lower deciles. And for the furthest right 3 columns, that all examines firms who began in the top decile. And so we hear that in 2007, we can see that 56% of firms who were in the top decile in 2007 remained there in 2009, while 44% dropped down. Look at that in 2009 and 2011, we actually see that companies that start in the top decile are most likely of all to remain in that decile. And this pattern strengthens over time, as we can see in the final oval with number 4. We can see it goes from 56 to 79. And again, this probably reflects the many effects of the financial crisis on like economic activity for the largest taxpayers. So next slide, please. So here we look at capital deepening. So like capital deepening, it indicates whether like capital per worker is increasing in the economy or not. And we can proxy for it by taking the ratio of tangible assets to it. How we arrive at tangible assets is we inflate the claims for plant and machinery capital allowances. And therefore we can kind of proxy for a figure for capital deepening. It's an important component of increasing labor productivity, which in turn is a long-run driver of living standards. So if we look at the darkest green line, that looks at tangible assets per employment for all companies on aggregate, and we can see from 2008 onwards there's a really strong increase. But if we exclude aircraft leasing, and we might want to exclude aircraft leasing because the underlying asset, aircraft, are located worldwide, then we can actually see that tangible assets per employment it's been relatively static since 2012. And then finally, if we exclude aircraft leasing, and we also exclude the top 10 who may skew the aggregate ratio and want to see how the rest of the taxpayer population behave, we can actually see that capital deepening's more or less been in decline since 2013. So if we move on to the next slide, please. In this table here, we look at an overview of 2018 Section 291A claimants, otherwise kind of known as companies claiming intangible asset capital allowances. And we look at these companies because they're becoming important taxpayers. They're becoming important because we can see in 2018 they account for 45% of all profits and 38% of all corporation tax liability. While in 2004, if we track that cohort of 2018 firms and we go all the way back in time to 2004, like we can see that they were quite not terribly important cohort of firms. So they only accounted for, let's say, like 3% of profits and liability. We can also, another interesting trend is we can see like a bit of a jump in 2011. I think there's a noticeable jump in their level of profits and corporation tax liability. And then in the last 6 to 8 years, we can also see that in the bottom row that this cohort of taxpayers, they're typically represent 1 in 10 of the very largest taxpayers in the last 6 to 8 years. And over the course of the years, the average tax liability for these firms has risen quite strongly. So next slide, please. Here we look at tax release and credits. So we look at the reduction in gross tax liability due to release and credits. And we can see that in 2018, release reduced gross tax liability by 17%, and that credits on average they're more important than, or reliefs are more important than credits. So you can see they account for a larger proportion of reduction in gross tax liability. If we look at the 3 credit figures on the furthest right, they're not as high as 70%. But the reliefs here, they're predominantly due to reflect the fact that many companies operate across several jurisdictions, and where Ireland has a tax treaty with that jurisdiction, the double payment of taxation on the same income is reconciled in this way via the tax credits. The financial insurance sector has been the main sector for double taxation relief and the additional foreign credit, while manufacturing is the main user of the R&D tax credit, and professional services and wholesale and retail are the main users of non-R&D credits. So next slide, please. Here we look at the share of the top 1% in terms of taxable income in items reducing gross tax. And we can see that the largest taxpayers, they use the bulk of reliefs and the R&D credit. There's a high degree of concentration in both. So like the top 1% in terms of taxable income, they use 95% of all reliefs. They use 83% of the corporation tax credit. And that concentration has increased R&D. It's increased in R&D, but it's reduced in recent years, while the use of total reliefs has increased also. So next slide, please. This figure here, annual employment over from 2004 to 2018, and also looks at the growth rate. To note that revenue reports employments, in other words, jobs, rather than employees. And to know first of all, and then if we the main kind of the trends here, we see that companies they would have, like, let's say, like peaked in about 2007 and like rebounded in 2011. And this was quicker than other business types such as sole traderships, partnerships, etc., which took until about 2012. So 2012 is when like the wider economy was in terms of employment figures. We can also see growth accelerated between 2011 and 2015 before it moderated in more recent years. And one thing we know as well is that Irish domestic firms, they're responsible for the bulk of employment growth among companies over the last 10 years. So next slide, please. Here we look at we kind of break down the changes in net employment. So we can see the total employment by companies in 2008 was about like 1.88 million, and we can see the total net employment change was 105,000 jobs lost. But the net employment change in shrinking sectors, so sectors that contracted in 2008, was about 126,000 job losses or employment losses, and the number of shrinking sectors here were 8. And while the net employment change in growing sectors was, I think, about 20,900 jobs. The number of growing sectors here were about 8. So we can see that about like half of all sectors experienced a reduction in net employment, while half experienced an expansion. But the reductions far outweigh the expansions in net employment. Next slide, please. Here we look at the sector decomposition of the net employment change in sectors that were like shrinking. So we can kind of see that here that net employment reductions, they were initially dominated by construction, but other sectors such as wholesale and retail and manufacturing were impacted heavily also. So you can see that construction is about 36% of the total net employment change in shrinking sectors in 2008, but kind of this dropped down to 16% in 2009, while other large sectors such as wholesale and retail were 21%, or manufacturing was a bit higher at 13 and went up to 23 again. So yeah, so we can see that other large sectors were also affected strongly enough as well. The next slide, please. So this slide here looks at the length of time to regain 2007 levels of employment, grouped by how much you contracted, how much the sector contracted between 2007 and 2010. So maybe if we look at the first 4 sectors, so manufacturing, construction down to administrative and support services, their average annual employment growth for those sectors between 2007 and 2010, it was on average like less than 10%, or sorry, greater than minus 10%. And then we can see that for manufacturing, it still hasn't reached its 2007 levels of employment. If we look at it, the employment share in 2013, we can see that, or 2007, we can see that manufacturing accounted for 13% employment in 2007, while it accounted for 11% of employment in 2000. And the cumulative growth between 2008, 2008 and 2007 is less than 1%. So it's kind of 1% below where it was in 2007, whether a sector like construction, which still hasn't recovered, it's 31% below where it was in 2007. And like not all sectors that contract quite a bit during the crisis years kind of fare badly in terms of their employment compared to 2007. So like we can see accommodation and food services, they're 32% than where they were in 2007, even though it still took 8 years for this sector to recover to its 2007 levels. And generally we can see that sectors which contracted the most during the financial crisis years took the longest to recover to their 2007 position. If we look at all sectors, we can see that it took until 2015 for sectors to return to 7. And this analysis, it is based on companies only, but if we look at all employer types per the CSO employment data, we can see it took until 2018, so 2 years later. And again, this kind of reflects the relative strength of companies versus employer types. And with that, I believe the presentation is finished. So thank you very much.
Donald, thank you very much. I'm going to ask Aisling Donough of Anderson to be the proposer of the vote of thanks. So over to you, Aisling. If you want to unmute there, Aisling.
I'm trying to unmute and trying to start my video and failing miserably with both. Maeve, do you have my slides?
I do indeed. I'll bring them up now.
Okay, that's great. Thanks a million. So if we just go to the next slide. I mean, I'd like to thank Donough for the presentation and predominantly for the work that went into the paper to begin with, because there was obviously an awful lot of data that they went through there. And while it's not going to tell us much about the future, it tells us some interesting things about trends and, you know, some very interesting things about tax reform, because I'm sure that most people on the call are aware of the fact that global tax reform is happening at a very rapid pace at the moment. And we're already seeing some of the consequences of the last attempts at global tax reform feeding through into Donough and Jean's numbers there. So the initial things that struck me when I first read the paper was how obvious things can appear with hindsight. And the most obvious point there related to the financial crisis. And so when we looked at the information about the finance sector, you know, with hindsight, it's really obvious that we were in a bubble and that it was going to crash, that there were going to be consequences. But at the time, working as a practitioner in the Irish tax market in 2005, 2006, we really didn't see that coming quite to the extent that it was going to come. Global tax reform has had consequences in terms of things that were announced or said in 2013, 2014, 2015. And that's already showing up in Donough and Jean's data here, which is really, really interesting to see. And so, you know, we had the G7 in the last week where they're talking about moving global tax reform on further. And your brain is starting to wonder what this data will look like if Donough and Jean do the same immense body of work in a couple of weeks, in a couple of years' time. So, you know, the pace that change is happening is really interesting. And again, that's something that's coming out. And the other part that's kind of coming out more in the paper and less in the presentation was the dog that didn't bark in the nighttime, which I'll get onto. So can we move on to the next slide, please? So I mentioned it a moment ago, but I think there's no harm in putting it up on the table. So putting it up on the screen. So table 3 related to current year loss claims. And so, if you look at financial and insurance sector there in 2007, it's 55% of losses. And then it goes up to a rather eye-watering 83% in 2010, because obviously companies have to have some kind of profitability before they can actually use their losses. And then if we look at the most recent year, 2018, it's back down to 16% of the total there. Whereas the total loss for 2010 was 52,000, whereas now it's down to 10,000. So, it's not particularly interesting to think about the Irish financial crisis in this data, but it's far more interesting when we move on to the subsequent slides, looking at the impact of global tax reform, how much things change. So yeah, if we go on to the next slide. So I just wanted to throw out some very, very basic dates, and it looks like I failed to save something on this slide, but anyhow. So in May 2013, Tim Cook gave evidence to the Houses of Congress about Apple having a special tax arrangement with the revenue commissioners in Ireland. And a lot of people in Ireland put their head in their hands when they heard him say that. That comment was a fairly major trigger for global tax reform, which is notoriously difficult to do. So in about June 2014, Margaret Vestager and the DG Comp started their investigation into Apple's tax affairs in Ireland. And simultaneously to that, the OECD BEPS project really started taking off in about 2015. And the other point that's missing there, that we will see in some of the slides, unless I've sent totally the wrong version of it, is the Trump tax reform sort of passed in 2017, but really began to affect the numbers in 2018. So if we just move on to the next slide. So I mentioned that Apple said what they said in 2013. Commissioner Vestager started investigating them in 2014. The world started getting quite annoyed at these structures and at the idea that there were large royalties leaving Ireland. And the BEPS project started kind of taking off. And so if you look at the capital allowances on intangibles data, which is, so if the Irish companies historically paid a royalty to Bermuda and nobody taxed that royalty, everyone was getting very, very vexed about those kind of structures. We have had this provision since, I think, 2008, which allows you to claim tax depreciation on intangible assets. And if you claim tax depreciation on intangible assets, then you cease paying a royalty to Bermuda. And you will notice there that the amount of the claimants for Section 291A relief and the amount of profits that have been claimed subject to 291A has gone up quite significantly. So we've gone to the next slide. In table 9, the guys rooted out the amount of trade charges being claimed as relief against corporation tax. And trade charges are significantly when you pay a royalty to a company, often a connected company, for the use of their intangible assets. And, again, as we kind of look at the total trade charges here, it peaked in 2015, which is roughly the same time as the BEPS project is really getting legs, and the world of tax becomes aware that these paying royalties to Bermuda structures, which were going to result in Bermuda not taxing the royalties, had a very limited shelf life. And so you can see these royalties starting to fall off here. So, if you look at 2015, 2016, it's at 24 billion. And then as we come back down to 2017, 2018, it's coming down to 17, 18. So that appears to be the BEPS project, both working and not working in real time, in that the BEPS project wanted to stop companies having income which was taxable nowhere. So it discouraged the payment of royalties, but because of the existence of Section 291A, A lot of these companies simply revised their structures, and instead of paying tax-free royalties to Bermuda, instead they brought the IP onshore into Ireland and amortized it, giving them a, depending on the company, not necessarily massively dissimilar tax result. So if we just go on to the next one. So my initial thought looking at this data was that it's causing me to ask a lot more questions than it is providing me with answers, because everything here is historic and everything about tax reform and tax changes is real time or in the future. And we have massive difficulty predicting that. I am fairly sure that an awful lot of the particularly tax NGOs would be outraged to discover that Ireland's corporate tax take was going to increase as a result of the BEPS project, even though most tax practitioners assumed that that was going to be a fairly necessary consequence of the project. And this has led to the original BEPS project now being superseded by what's being referred to as BEPS 2. So that's base erosion profit shifting, even though BEPS 2 doesn't deal with base erosion or profit shifting at all. It deals with the idea that some countries are claiming a lot of profits in global groups and not necessarily taxing those profits, while other jurisdictions that are generating a lot of the profits by providing particularly tech companies with an awful lot of the users don't have any ability to tax those profits at all. So, at the moment, everyone seems to be agreeing that global tax reform is necessary and assuming that it will progress. But as is always the case with these things, compromises will be reached, the progress will be less rapid than people were expecting it to be, and sometimes various states will put their own national interests ahead of any sort of perceived global interest, and that will delay things. And traditionally in the world of global tax reform, it's the US that is the main driver of these things. When the US is insular, nothing happens. When the US is outward looking, things can change. So, there's a degree of optimism around the Biden presidency. What will the future look like? We don't know, because, looking at that historic data, we can see the impact of the financial crash. We can see the impact of BEPS 1, as it now would be considered. We don't know what the actual impact of BEPS 2 will look like. But, we have, as Donough explained, a huge concentration problem. A small number of very large taxpayers account for a very large amount of the tax take. And so even something as small as tax reform I was discussing with Ronan earlier that Seamus Coffey did a piece in the last week or so about the possibility that Microsoft may be paying as much as 1 billion in corporation tax in Ireland in a year. So even something as small as a change in the state of Washington in their state taxes, but not in federal income tax, could cause Microsoft to do something which then could have a material impact on the Irish tax take. So, I'm just fascinated by this paper. I just keep looking at the various tables, and I really would like to thank Jean and Donough for the work that they did.
Thank you so much, Aisling. So as you said, thank you to Donough and to Jean for putting that data set together and the analysis of it. And you pushed it on as well then, Aisling, as well, with some insight. So let's open it up to observations or questions from the floor. We'll try and do a hard stop at 6 o'clock. So anybody want to be the first to come in there?
Danny, if you check the attendees button, you'll see a couple of hands raised there.
Sorry. Just
John,
get that.
Sweeney, I think, are the first two.
Oh, sorry. Yeah. Apologies. You say it again. I'm just not seeing the hands actually. I do see them now. Sorry. John Fitz and Paul Sweeney. Yeah. John, if you want to come on, John.
Right. All right. very useful paper. It's just two questions. One, in terms of the losses. If, for example, a bank goes bust, and we won't name a bank, do the losses drop out of the accumulated losses, or they continue on in them, in the losses? And the other question is about the depreciation allowances. You'd expect you have a company that has huge intellectual property and moves to Ireland, and the value of that intellectual property is very large, which means, and they're able to write it off against their corporate profits. So there's very little taxable to begin off with. But providing that company actually does make profits from its investment, and we assume that these companies, very large companies, do eventually make a profit on the investment. Once that intellectual property is written off, presumably then the residual, the profits thereafter are taxed at the full rate. Or is there some way, if these companies left Ireland having used depreciation allowances, that no profit would ever accrue to Ireland? So it's a question about how the corporation tax system works. Thanks.
Donough, would you like to come in, or Paul, would you like to ask your question if it's broadly?
Yeah, I'll ask because it's related. I was intrigued by the amount of companies, I think 356, that managed to survive without making or having any CT liability. And the question is, it's a bit like John's, and in fact, Aisling kind of answered it to me a bit. Is it because they have losses forward? In the case of the 6 Irish banks, they all collapsed and had huge losses forward. Is it wear and tear, capital allowances, intellectual property, or is it tax avoidance schemes? Are they making profits to survive? I'm sort of intellectually intrigued. How can they survive without paying any tax? It indicates no profits, but I do know that companies can, and certainly the Irish banks, after their collapse, have huge losses forward that the government, foolishly, in my opinion, allowed them to continue with, because we own the banks, so they want them to be viable.
Donough, do you want to maybe take up those to start with?
So I didn't catch John's question. I was kind of kicked from the call, but I caught the second question, and that was about the second question was about, was it the probability of what was the start of the second question again there, sorry?
If I just repeat the question, the first was losses on a bank that goes bust. Do they continue on as losses in your table, or do they disappear out of them? And then my second question was on the depreciation allowances. Once they're used up, companies presumably pay tax on all their profits. Or can they move out of Ireland before they start paying profits, having written off their intellectual property?
Okay, on the first part of the question, sorry.
Keith, are you on there as well? Would you be able to give some insight?
Donough,
we're having difficulties hearing you.
Hi, it's Aisling here. Just while you're trying to get to those guys, I can just answer on a technical basis. If a bank dies, so let's say that a bank is totally liquidated, like Irish Nationwide, then those losses will completely die because the company will stop filing tax returns because it will cease to exist. But if a bank gets itself into trouble, so there was a Tax Appeals Commission determination where one of the Irish banks sold a loan book to one of the asset finance houses, and I think it was reported that it was Pepper, and Pepper tried to claim to use the losses forward that the bank had incurred on that loan book, and Revenue took the case to the Tax Appeals Commission and they won. So those losses ceased to be available to anyone. They ceased to be available to the bank because the bank no longer owned the loan book, and they couldn't be transferred to Pepper along with the loan book because Pepper was doing different things with the loan book to that which the bank had done. The bank was making loans, whereas Pepper was just running out a portfolio of loans. So with the specific example of the Irish banks, a lot of those losses if the CT returns are filed properly, and we have no reason to believe that they're not, those losses should cease to be included on the CT returns. And so hopefully they should fall out of the data that Jean and Donough are using.
Thanks, Aisling. Donough, I don't know if you can hear us. To John's other point about companies that may use up their capital allowances, and then at that point, is there any exit tax effectively if they were to leave the jurisdiction?
As far as I'm aware, I'm not aware of any exit tax at the moment. As soon as their capital allowances are used up, and they I'm not 100. I can double check it and.
Again, sorry if I'm leaping in.
No, go ahead, Aisling, please.
Because I can't hear you. I mean, in terms of if a company acquired, so let's say an Irish company acquired intangible assets from its Bermuda parent company a couple of years ago. If that Irish company leaves the Irish tax net with those intangible assets, there is an exit tax under a piece of EU legislation called ATAD, the Anti-Tax Avoidance Directive. And so Ireland always had one kind of exit tax. ATAD required us to make that exit tax a little bit broader. There is some planning in the marketplace that indicates that the exit tax doesn't apply in all scenarios, but there clearly is an exit tax, and it clearly is intended to apply in a lot of scenarios.
Great, thanks again, Aisling. Paul's question was, how did these companies survive for so long, the 300 or so?
Well, that one, I'm desperately hoping that Donough can come back in here with decent coverage, because I don't know what these companies are, but I mean, it is quite possible that you could have a company like, let's say that we have Widgets Limited, and Widgets Limited makes widgets and sells widgets, okay? So it just makes things, it sells things, it's profitable. There is a holding company sitting over Widgets Limited. The holding company, its only potential source of income is a dividend from Widgets Limited, which is another Irish company. And so that holding company doesn't pay tax on that dividend income. So it's not that it doesn't have any income, it's that the kind of income it has, a dividend from another Irish company, just isn't taxable. So without knowing anything about the data, huge caveats here, I'm instinctively guessing from my 20 years as a tax practitioner that a lot of these companies are holding companies. Some of them are just in small Irish groups, some of them in large multinationals, some of them in Irish PLCs. But oftentimes you will find that the PLC company in an Irish group has no taxable income, because there's other Irish companies below it which run the various operations of the group. So, you might find, and I'm just picking an example off the top of my head, I haven't looked at it, you might find that CRH PLC doesn't have any taxable income, but that there is another entity called Cement and Roadstone Holdings Limited, which has loads of taxable income because it's the entity that's actually doing what we associate with CRH. Now, there may be other reasons why companies are hanging around for years, and if Donough's bandwidth is up to it, he might be able to give some better examples, but certainly one example would be holding companies.
We're talking about companies that have, is it no corporation tax liability over the period, is it?
Yeah, the 300 or so companies that haven't been profitable since 2007 all the way through 2018. So 15 years of no profits.
But still surviving, how are they doing? I can understand a company like, say, Ryanair, which has big profits, but is buying loads of airplanes, lots of write-downs of capital, so maybe they're not liable for tax. That I understand, but there must be others.
Patrick, I don't know, we can't hear you, but Patrick Conan
so these firms. Oh,
Donough, would you try and maybe go through the hotspot on your mobile phone to give you coverage? That sometimes boosts it up. If you just go into your hotspot, just try that one. It might give you more bandwidth. Patrick, do you want to ask the question, and we're doing the metal version of corporate tax advice here.
Yeah, no, my question is not about how it's treated. I'm more interested in the statistical presentation of it, and I think it's really very interesting material. And I feel there's a lot more can be done with this data, but I'm wondering what I would do with it. What additional things I would do with it. I have three questions. The first question I think may be similar to the one Paul Sweeney had, but I think I'm talking about a different number. I'm not talking about 200 and something companies. I'm talking about 64,700. It's the difference. More than 100,000 companies. About 60% of the companies in any given year here have no positive CT liability. Now the headline might be, if the journalists online are writing their story for tomorrow, the headline might be 40% or 60% of Irish companies don't pay any corporation tax. And I'm wondering, can we drill down on that a little bit? It seems plausible to me that a lot of these companies, they don't have corporation tax liabilities, and they don't have much else either. That they are small companies that were set up, they have to file returns, but they're not doing anything. They don't have much in the way of assets. They don't have much in the way of profits. And is there some way of slicing through the difference between companies that are small and negligible and could be de minimis in this, and larger companies which by shrewd tax management and all sorts of reasons are in fact sheltering large global profits in some way? My second question is the following. Figure 8, page 20, very nice to show us the trend in the top 1%, growing to almost 1% or something of the 1% have almost 90% of the tax paid. But I felt myself hungering for more about the distribution. Is there just a clump of companies? We know they're top 10 and we know what percentage they pay. Could you draw the distribution of companies and where the concentration, where not just the top 1%, but the top 2% stuff, the whole distribution? I think that would be very interesting. I suspect it might be, there might be, bimodal, and there would be funny shapes there, and would really allow us to get to grips with what is actually must be considered to be a two-tier system. There are big multinational companies making tens of billions of profits worldwide, and then there are ordinary companies. I think that would be really interesting too. And is there a barrier to doing that, or is it something that could be done in future? And my final question is, it's about figure 7, which is on page 18 of the paper that was, and it has a very interesting. This does have a distribution of between the low payers and the high payers. I see page 17. I'm sorry, you probably have this. Let me get it back in front of myself. This is the one that shows with different colors the recovery phase, the recession phase, the stabilization phase, the maturity phase. But the most dramatic line is the so-called recovery phase, which is 2009 to 2012. It's the dark blue dots all across the chart. And at first I thought, well, this is something obvious is going on here, because we'll see that the companies at the lower percentiles are having very large percentage growths. Perhaps because they had zero. Or is it zero? Will there be zero? If it's zero, why are they not millions of percentages? So I thought that would be interesting to understand why in that particular period, 2009 to 12, is actually not really a recovery period in economic terms. It's just a period of still decline or stability at best. So what's happening at the bottom, and especially what's happening at the top? We see just at the top, the last 5%, there's a substantial increase in tax liability. in that period, and not in the subsequent period of stabilization, 2012 to 2015, which was the period in which, in 15, we had this huge increase in total tax take. But looking at the chart, it looks as if that increase in tax take was spread right across the percentiles, which I don't think was the case. I think it was a few big companies in that case. So I'm really trying to get to grips with that. It's really interesting statistical material. Thank you.
Thanks very much.
Thanks very much.
Go ahead.
Thanks very much for that, for those questions. So to look at your first question, which is on the 60% of companies typically who don't pay positive tax liability, I haven't shown to them in the paper, but like typically these firms, like let's say there was about 93,000 of these firms in 2018 that had no corporate tax liability, or it was equal to zero. Like typically, if these firms, they're typically in finance, wholesale and retail, and construction. They'd be the largest sectors, and they'd typically be like about, if we look at their date of incorporation from the CRO, they're typically about like 10 years old, but the majority of them, let's say about just under % would be less than old. So they seem to be maybe young enough firms. But then again, like there's a caveat with using the company's registration to corporation, because a subsidiary of a foreign multinational is not, a young multinational is probably not going to be the same as a young kind of domestic firm starting off. Then if we look at their the employment records again in 2018, they like, it's for companies that pay no tax, they account for about approximately 20% of all employments in 2018. So it's a sizable amount, and the vast majority of these firms, they're micro firms. So just about nearly 80% are micro firms. Have too much more detail on firms who have zero corporation tax liability. That would be kind of a quick overview there. They do have large amounts of losses, current year losses, and loss forward relatively large amounts. So maybe that answers your first question of like who are these companies with no liability. In terms of like figure 2 or question 2 on the trend in the top 1%, I think you're kind of asking, like, is there more information than just this trend? Can we can we look at maybe more information on the top of 1% or whatnot? And I feel like would be is yes, you absolutely can. We could do more research on the distribution of firms within a certain distribution. So like the top 1%, the top 0.1%, the top 10 firms, and they're from my experience of looking at data, they are like different. So you can see the level of penetration between the top 10 and the top 1%. That there's a massive difference there, and like those firms, they would be like difference. They would have differences characteristically in terms of like sectoral breakdown and age and whatnot. So like there is scope there to do more analysis on that aspect and drill down deeper to just as opposed to just the headline concentration figure. And then your last question on
you could also go out to 5% and 10%, not just below 1%.
Yeah, you really could. You absolutely could do that, definitely, and that's something like we can look at. We can like note that down and put that on the list. Research questions. Maybe for your last question on figure 7, you're talking about the district. You were like questioning the extreme growth rates in the dark navy, the dark blue line, the recovery thing. You were questioning those and kind of what's happening at the top and what's happening. Those recovery years weren't as as the recovery wasn't as strong as you thought, that maybe I think you're saying more of that growth should be in the stabilization period. Like the answer there is I'm not percent sure period, and not in the stabilization period from 2012 to 2015. I didn't drill down into it too much, so I can't give you a definitive answer, but I can definitely make note of that and put a comment in the kind of the final edition of the paper.
Okay.
Thanks, Donna. Eddie Casey, Eddie, would you like to come on there on screen with your question?
Hi, Danny. So thanks for that. I was cooking dinner. It was very enjoyable experience. But yeah, my question was just about the concentration that Ireland has in a handful of companies. So I think you mentioned that the top 1%, is not unusual to see a high level of concentration among the top 1% of payers in terms of overall corporation tax receipts paid in other countries, and you mentioned Singapore, for example. And I guess that's not surprising. So you see, the top 5 companies in the US would account for nearly 20% of the S&P 500, 5 tech companies. But is Ireland relatively unique in terms of the share of corporation tax that's coming from just a handful of companies, so say 10 companies?
Thanks, Eddie. Donna, on mute.
Hi. So you're asking, is Ireland unique because of the share of GT coming from a handful of companies? So like presumably the top 10 accounting for, let's say, 51% of payments in the most recent paper. Again, to answer that, I can imagine it is relatively unique. I can't imagine the concentration is that intense in other countries, but I haven't done an explanation of what they would be in other countries, a smaller number. The reason being is like the data it's not always accessible, and it's not always accessible in the same format, so it's hard to make comparisons. But I can't imagine that it would be. I can't imagine there'd be many more countries who have around 10 companies account, 51% of payments. So hopefully that kind of answers it.
Thanks, Donna. I see Keith is there. Keith, do you want to add anything? We brought you into across the divide there. Is there any gaps that in the broadband problems that Donough's having, that something might be missed?
Hi, Danny. I'm not sure. Can you hear me now?
Yeah, I can hear you now.
Right. Sorry, I was having a few connection problems of my own. It seems to be a common trend this evening, unfortunately. Yeah. Look, I suppose I think Donough is more familiar with the data than me, and has tried to answer the questions, and probably has a better grasp on them than me. I think one thing that would be of interest, I would say, to probably going back to some of Patrick's earlier questions and Paul's earlier questions, is we, as people may be aware, we publish Donough's paper and Jean's paper is really interesting because it gives us a 15-year perspective going back over a number of years, but we publish an annual paper every year that drills into the most recent year in more detail, and then there's a whole series of statistics on the revenue website that kind of backs up that paper, and again goes into the most recent year in most detail. And I think some of that distribution information that Patrick is looking for is probably on our website or in some of our publications already. So as absolutely, we can look at adding it into the version of the paper that goes into the journal, Patrick. But if you want to drop me a line, we can try and see if there's anything else in the published information that might be of use too. Some of the discussion earlier, I suppose, around what I think is probably one of the most interesting things in the paper is this group of companies that are persistently not making any profits or not paying any tax, and they don't drop out, that they kind of stay in the system. And in the system and filing returns. As Donough said, as Donough has shown, there is quite a level of persistence there. And I think the other point he was making is that they are generally quite small companies. So, you know, these aren't large companies, but they're sort of small companies. They might have 1 or 2 employees at most in a lot of cases. So they tend to be at the smaller ends. They may have incorporated for a reason going back over a number of years, and then have just decided they prefer to stay in the corporation tax system rather than moving into or back into sort of self-assessment, income tax, or sole traders or SMEs. But it's kind of hard to get a handle on the reason for it. But I would stress that I think a lot of these are quite small companies. So I think those are probably the main things we could say. You know, back to, I suppose, Eddie's last question. Like my sense is that, as Donough said, it's very hard to make these kind of comparisons and the concentration across countries. But I might, because the different kind of metrics that are put out there in countries differ, and obviously we don't have access to the more detailed data, but in other countries, and other countries haven't put out the same level of information that we have, I think, in some cases. But my sense is probably the concentration levels might be similar enough if you're looking at the largest companies in any particular, in a lot of the large economies too. It's just it's agglomeration and a lot of the kind of the effects that you would expect to see. So that's kind of my sense is that the concentration probably wouldn't be that different in other countries.
That's great. Thanks very much, Keith. Donna, I might leave the last word to you if you can come back in. We close up. Any last?
As close as I can get. I wouldn't have any further kind of remarks to add. Just to say, thanks to everyone for their showing up and for the questions and the feedback and the guidance in the paper. Much appreciated, and you know, getting feedback from people is always really important to improve the end product. So and the critical discussion as well. It's all. Thanks very much for that. I really appreciate people taking the time out.
Donna, thank you very much. Thank you to Jean as well, your co-author, and to Aisling for the vote of thanks. Ronan, over to you to just the final piece of information.
Thank you, Danny. So thanks to everyone for coming along and contributing today. I'll be following up with those who have contributed to get a written summary for the journal, as is the tradition, not just from today's session, but from all the online sessions. The other, I suppose, innovation that Danny mentioned earlier is we've been going online. So all of the talks from this year's session are up on the Society's YouTube channel, which we haven't made a huge fuss about as of yet. But now that we have a full session's worth of material, you can watch back in your own time. So I'll be, for those who did make contributions, if you can email them through to secretary@cisi.ie. Otherwise, I will probably go through to the video recording, try and summarize myself, and get in touch with you in due course as we prepare for the journal. That's I think the close of the session. So I'll be in touch with our mailing list in September about the next session. But I think Danny and myself and all the officers would encourage those of you who are engaged in research and analysis in relation to policy relevant material, if you can consider the Society for presenting that material, we'd be grateful. It's always great to see what's happening in different parts of the system. And I see Maeve has just put up a link to the Society's YouTube channel, which is probably the right time to thank Maeve and Tris for all their support since the outbreak of COVID in moving us after 173.5 years, moving us online. So thanks to Maeve and Tris for their help.
Yeah, echo that. Thank you very much, Maeve. You've been absolutely really valuable resource to us right throughout the session. So thanks to everybody. Wish everybody a good summer, and look forward to our 175th session in September. So thanks again. Bye.